And with that, I'd like to invite Mr. Phillips to provide his insights on the impact of government policy and market opportunities. Thank you.
Well, thank you, Julie, and excited to be here. And I normally kick these off by asking the room questions, and I know I was supposed to be in there in person, but this is how we're all adapting and flexible with our time. But I like to ask people, who in here likes talking politics? And those who are more client-facing, who likes talking politics with clients? And I rarely get more than 10-15% of the room who raises their hands when I ask that question. But then I asked a second question. I said, who in here, and this is great for a CFA audience, CFA charter holder audience, I say, who can name a sector or even made a portfolio change after Trump was elected into office based on the expectation of policy? So you can think of defense spending, tax reform, energy deregulation, financial deregulation, who made a change? And that's when I see a lot of hands shoot up, usually more than half the room, where they can at least name a sector or subsector that was impacted by a policy change, or even in most cases where they've made a change to their portfolio or clients' portfolios based on the expectation for policy support for certain sectors. And so right there, and that's kind of one of the key takeaways I want from today, that people understand intuitively the difference between politics and policy. And so that's something we're going to talk a lot about today, making sure to differentiate those two. Real quick on just how we came about, because I think it's important to share, where we came from and why. I've spent my whole career at buy-side asset management. So I've always been mutual fund management or hedge fund management, whether it was at Lord Abbett or Providence Equity doing long short there, or at GSAM. But it was when I was at Goldman that my partner came to me, and he was on sell-side research at Goldman. He came to me one day and said, Ben, all my clients are calling, and these are hedge funds, institutional investors. They're all calling asking what's going to happen to defense spending if Hillary gets elected, or what's going to happen to healthcare if Trump gets elected, or how can I play this tax reform thing? And we realized that Goldman wasn't doing a good job answering these questions, or at least translating them into investment ideas, actionable investment ideas. And that's where this whole idea came about. It's, wait a second, what if we look at policy as this leading indicator? And so we kept researching it, came across the Harvard research I'm going to touch on, realized that nobody was even investing like this, and there was an opportunity, and hence why we went out there and launched the first ever government policy-based ETFs with PLCY being our flagship, and that evolved into this MarketDesk Research, which I'll just touch on briefly at the end. But real quick, what happened was, we launched in October 2017, but very quickly got out there front and center, and it was because the message was so interesting. So the media, was very interested in what we had to say, because we were connecting what was going on in DC and state governments and federal agencies. We were connecting that all the way to actionable investment ideas, whether single name stocks, bonds, or subsectors, or even broader sectors. So really our clients are financial advisors and RIAs, family offices, as well as institutional investors. And that's really who pays attention to what we're doing in portfolios, as well as reads our research. So today what we're going to talk about, I have to touch on the viral recession. I don't know what we're going to call it, the Great Lockdown. I'm seeing different names out there. But we're going to touch on just, some of the current things going on there and what that means, because that is very policy driven and impacting the markets clearly. I am going to touch on the policy does not equal politics, really how to look through that noise. We're going to look at various policy catalysts, where we're talking about these uncorrelated alpha sources, and I'm going to give at least 10 in depth and then a few more bonus items at the end. But I really want to share those with you, and that kind of bleeds right into the investment cases. How does this policy disruption work? How can you actually invest in it? And then share some more themes in there. So it'll be scattered about. The 3 through 5 are kind of all blended into one, but I want to touch on all of those. So as I mentioned, politics is really that noise. It's the government conflict and debate. It's the emotional side of things. It's candidly sexier. It's what gets all the attention of the media. It I think distracts a lot of investors because it is that tabloid-like material out there and content. But at the end of the day, it rarely results in policy, and that's what I want people to understand. Is policy is much slower moving. That's the actual legislation, regulation impacting companies and industries. And that's where we focus all of our efforts, is really cutting through that political noise and looking at the policy changes. This is one, and if anyone wants to see a copy of this, I'm happy to shoot it over because we don't publish this widely anymore. But this just to show you, does government policy drive markets? I mean, there's over 200 single name tickers on here. that are all impacted, or all have been impacted, or are currently being impacted by policy. And this is really scratching the surface. These are the big items that are impacting companies. And you know, it's all encompassing of a lot of different U.S. companies. But again, you can see that really every company in the U.S. is one way or another impacted by policy, and that really goes across the global universe too. So where do we look? You know, I think when we're talking policy, everyone tends to focus on the Fed, right? Monetary policy, in our view, is one of the most over-scrutinized. So we look at the 4 policy factors. We look at monetary, fiscal, trade, and regulatory. But again, everyone, you know, focused on the Fed. We think of those 4 policy factors, the monetary policy side is probably the only one that's fully scrutinized. The fiscal, trade, regulatory, a lot of times people miss the mark there. And so we spend a lot more time on that. But I wanted to call out that right now, obviously, the Fed has done a lot. I said $6 trillion. Wow, like that's massive. And you can just see on this page everything they've done since March 3rd with that first emergency rate cut, and then the one following within a week and a half. And then you've seen all the facilities come in and the massive QE4 that's been started, effectively unlimited. And then this $2.3 trillion lending program. So they've clearly done a lot. But and I also want to share, the fiscal side of things. So fiscal is usually the second thought in people's mind when they think policy. They think Congress, they think D.C. And that clearly matters, especially right now. As you can see, the CARES Act, $2 trillion. You can see where all the money was going there. I think the left chart is the most interesting here, where you look at the change in fiscal balance. So kind of how much fiscal spending is a percentage of GDP, and it's dwarfing 2008, 2009, which I think is just fascinating to see. We've heard the word unprecedented a few times in the past month. What the Fed has done, the fiscal spending side of things too, are truly unprecedented. We haven't seen this level of activity from the federal government to help support the economy because, and I think everyone's seen the numbers, job losses and all that. This is an unprecedented drawdown in economic activity. So how did markets react to that Fed facilities and the fiscal? Well, clearly markets are impacted by policy because you saw these are all the fixed income. So I have HYG, that's in hot pink. My color coding is related to the asset class. MUI, Muni, is in maroon. I got VVR, and then I got LQD, which is LQD is my investment grade bonds. So just looking at just how these asset classes are performed, really the Fed stepped in right here at kind of the lows. And that's where you've seen the market confidence rebuilt when the Fed said, hey, we're going to buy investment grade bonds. We're going to buy munis. That really gave the market confidence, and you saw that reflected in the asset classes. So I want to touch on, as far as how does this work? What are we investing in actually? And you'll see we spend a lot of our time in the federal agency and state policy. So I think a lot of people, immediately assume, okay, this is, congressional fund, it's legislation out of DC, maybe some executive action. But really, if you look at it, at the end of the day, where we spend most of our time, because this is what the market largely misses, are the federal agencies and state policies. I think one reason is people fail to realize when Congress passes a bill, that's really just an outline. That's an outline for the regulation. And so you could think of, an energy bill, for example. Congress passes a bill, it gets signed into law by the executive office, the president, and then it's really up to the agencies who are tasked with implementing that law, writing the rules and regulations. So you'll have like the EPA and FERC, for example, in some energy legislation, but that's a 2 to 3 year process. And so we spend a lot of our time looking at that after the fact. Looking at, after something passes, how is it being implemented? How is that going to impact companies? Because that's really, in our view, what impacts things. So you'll see everything highlighted here in green. These are our different policy themes that we invest in, that we're currently invested in as of March 31st. How much are they impacted by Congress? The ones that are not highlighted are the ones impacted by Congress or the executive office. So like defense, global trade, uranium. Everything else on here, healthcare innovation is CMS, government technology is state and local governments, as well as, there's government REITs in there. 5G telecom is the FCC, infrastructure, state governments. Everyone thinks it's a federal story. That's wrong. We'll touch on that later. IMO 2020 is the International Maritime Organization underneath the UN. Renewable fuels is EPA, as well as states. Sports betting is Supreme Court and states. Cybersecurity is federal agencies. And then you have tobacco in there, FDA, media deregulation, FCC. So you'll see these themes are largely outside of Congress. So how do you invest in this? And I'll give some of our core tenets and how we go about looking at the world, and which has really driven our success in alpha generation. But really the thesis is policy drives fundamentals. And so we're looking for those companies and those subsectors and sectors that are going to be impacted by government policy catalysts. So really Washington, as well as state governments and agencies, create these investment opportunities. I'm going to keep saying it because I think it's important for you to take away from today is that policy and politics are not the same thing. So that's one of the key takeaways. Policy is really that leading indicator. Politics, as I mentioned, is largely noise. And the best thing about policy is that it really is well telegraphed. You just have to know where to look. It's long term. It's very much impacting companies and industries over 5, 10, 20-year periods and longer, and it's lower correlation too. So that's something we like. It tends to be cycle agnostic and sometimes almost counter-cyclical in that you look at times like right now, the most policy activity we're seeing is in bad markets. We saw that kind of with Dodd-Frank, Obamacare after the 08, 09. So the opportunity, it really is simplistic. I think, again, a lot of people miss it because of all the noise surrounding it. But, we saw the latest and greatest with tax reform, right? It impacted every single U.S. company. So we say that U.S. policy impacts 100% of U.S. companies, and it's not even tongue-in-cheek. It's literal. No company is immune to these government policy changes. If you do business in the U.S. or have any sort of U.S. presence, you are impacted one way or another by tax reform. And you're seeing that kind of with the current fiscal stimulus that is impacting a lot of companies as well. Washington's complex. A lot of that political noise. There's a lot going on there. Our goal is really to help connect the dots for people, and we're looking through all that noise and helping identify winners and losers, so you can buy the winners and avoid the losers, or short if that's your cup of tea. Abundant opportunities. There's Congress passing 750 bills per year, the Supreme Court ruling on 130 cases per year, federal agencies issuing 3,800 rules. That's what I mentioned. That's really the meat of regulation. It is happening at the federal agency level and the state level. And then lastly, the Harvard research that I mentioned. There's a piece out there called Legislating Stock Prices. It's a public piece. It's available at nbur.org. So you can just Google legislating stock prices if you want to read that abstract or the entire paper. But in their study, they generated 11% per year of alpha annually. So that's 11% per year over a 20-year period. So it's out there. You just have to know how to capture it. And that's what we're going to share today. So policy investing, really looking at these uncorrelated alpha sources, right? So we're looking for areas of the market and different companies and sectors that are undergoing a business model change because of government policy. And as I mentioned, a lot of people immediately assume that's congressional, but I would say that's one of our lowest areas of focus because we see things that are impacting markets coming out of these other areas. So judicial, Obamacare, ACA, we had sports betting, right? That was judicial. We're going to have cannabis one day come up there to Supreme Court. And so that we're looking at that too. The states, states matter a lot. The Supreme Court ruled in May 2018 that sports betting was legal. Well, it was really up to the states, is what the decision said. It's up to the states to decide. And then lastly, the federal agencies that I mentioned, that's a really big area. There's over 100 that we watch closely, from FDA, EPA, FCC, CFPB, CMS, just to name a few. So I find this data really interesting because this is from the University of Michigan survey. We're looking at sentiment today and how it's changed, since really kind of Obama era, where you've seen government and elections, that's the red line, has become front and center in business owners' minds. What impacts your business is what, the question is in the survey. What are you hearing in the news that's impacting the way you're running and managing your business? And it used to always be employment leading the race there, and employment was number one. Employment's still very high on the list, but it's interesting to see government and elections policy has overtaken employment as the number one concern on business owner and business leaders' minds. So I think that's pretty fascinating. It's not the stock market, it's not consumer demand, it's not credit availability, it's not prices, it's not trade deficit. It is policy and then employment. So interesting to see that data is actually, out there. And then I would say the more, I don't know, concerning or negative side of this is that this has led to further political polarization. So the silver lining is that volatility that creates the opportunity for people like us on this call, CFA charter holders who are investors and us who are specifically investing in policy catalysts. It creates that opportunity because there's that noise out there that creates volatility, and that gives us an opportunity to express our views. But what this survey is presidential approval. So it's this: if you were to ask a generic Republican if they would vote for a generic Democrat, and vice versa, the answer 9 times out of 10 is no. And that's I think where we are as a country right now is we have seen this political divide, and it's something that I'm very curious to see how this plays out. But right now the trend is suggesting that we're just getting more divided. So I wanted to call that out. So let's talk about some policy themes that are driving markets currently, and then we're going to talk about some that are just kind of kicking off and have longer tails too. So IMO 2020, I mentioned, this is low sulfur fuel regulations that are really disruptive to a wide swath of the market. Sports betting, it's really legalizing this multi-billion-dollar opportunity. Infrastructure spending, I think the focus should be on the states. States are 70% of spending for infrastructure in the US. So it's not a federal story. The federal supports it and can help things, but in our view, federal is really just gravy. And then sales tax compliance. We're going to talk about even just instances where a policy change can impact a single company. And so I want to call that out. And then defense spending, talk a little bit about its recession resistance. So IMO 2020, as I mentioned, this is it's the International Maritime Organization underneath the United Nations. So this isn't a regulatory body that is regulating seaways. So how, shipping, global shipping, it's a regulatory body that really oversees all of that. And what's happened on January 1st, 2020, we had a change, and the sulfur standard went from 3.5% sulfur allowed in bunker fuel, diesel for shipping, 3.5% to 0.5%. So it was a major change. All of a sudden, you saw, the last place on earth where you could burn this dirty high sulfur diesel was over the seas, and now they can't. And so you've seen this divide, and the chart is showing the price differentials, the red line, that's the one to focus on, between the low sulfur fuel and the high sulfur fuel. And you've seen that the high sulfur fuel, really the price has collapsed, and the low sulfur fuel has held in there because there's not much demand for the high sulfur fuel. Now, how we're playing it, we're looking at the companies that can keep burning high sulfur fuel. We're looking at the fuel logistics companies that can help alleviate this burden and this disruption. And so that's really where we're focusing a lot of our efforts. Naturally, this thesis has been and is being impacted by energy prices. So I just caveat that, you're not completely, getting away from energy prices. But at the end of the day, this is an interesting theme that is really being driven by a global regulatory body impacting a lot of US companies. So sports betting, I have to talk about it. I think a lot of people, flipped off that, sorry. Sports betting, like I mentioned, it's a Supreme Court decision in May 2018 where they effectively said, okay, it's in your hands, states. You can decide whether or not to legalize. And since then, we've seen 12 states fully legalized. We've seen 19 states with bills introduced, and you'll see the map. I mean, by the year end 2022, we're expecting 40 of the 50 states in the US to have legalized sports betting, and that growth opportunity is going to extend, into the mid 2020s at the very least. So we like sports betting a lot. This current market disruption has caused gaming names. People think that, you're never going to go into a casino again. It's created some opportunity, especially for those gaming companies with high sports betting exposure. We like playing some of the new emerging technologies. We like playing some of the content. So if you think like a Fox or Sinclair, you're going to be watching a sporting event in a year from now where hopefully we're going to be watching a sporting event where you could make a live bet through your remote controller or through your phone. They're going to put live odds on the screen if you have that enabled. So it's really the integration with content is pretty interesting too. So we're playing it through that way. And then we like some of the regional operators too, that are going to see more traffic in our view. So let's touch on infrastructure. And as I mentioned, it is a state story. And I think that's where people miss. They say, when Trump got elected, it's never going to happen at the federal level. We agreed, but infrastructure has always been a core part of our portfolio. Reason being, the states are spending. They make up 70% of infrastructure spending. And you say, well, how are they paying for it? And that's the really interesting part. States have been raising fuel taxes and raising vehicle registration taxes and other vehicle transportation taxes to pay for infrastructure. That's the use of proceeds. So we've seen 33 states raise fuel taxes since 2013 to pay for infrastructure. And our view is that if there is an infrastructure bill, particularly in this current environment, that's really just gravy to these names. And so we still really like this thesis, and this is something that's playing out right now in Congress if there is a federal bill. So that's, again, that just extends this thesis multiple years. So I mentioned I'd talk on just one company that was impacted specifically by a policy change, and this is to show you it can get all the way down to the single company level. So if you look back a few years ago, and think back 10 years, right? When you used to order something on Amazon, it would you'd click buy, and then you'd see your receipt, and you say, "Wow, I didn't pay sales tax on that. What's going on?" Well, hey, I'm a consumer. It's less money out of my pocket. I'm happy, right? Well, the Supreme Court and the states weren't too happy about that. The states said, these transactions are occurring in our state, and effectively Amazon's dodging sales tax. Well, it went all the way up to the Supreme Court, and it was called the Wayfair decision. If you know Wayfair.com, the home goods and furniture and things like that. The Wayfair decision effectively ruled that all e-commerce companies have to collect sales tax at the point of sale in the state that transaction is occurring. So if you're in Michigan and you click buy, doesn't matter that Amazon's shipping it from Illinois, let's say, that you have to pay sales tax on that transaction. You have to pay Michigan state sales tax because that's where you're based and that's where the final goods are going. Well, nobody was ready for that. So there's patchwork of state tax laws, state sales tax laws. They're all different. It is not easy for an e-commerce company overnight to all of a sudden have to comply with that based on a Supreme Court ruling. So Avalara saw this coming, and they were there. They were there with the only software solution, or one of the only software solutions, and the best, in our opinion, to help companies comply with this sales tax regime, new sales tax regime. And so you see the stock IPO at the bottom left. It IPO'd actually, I think, at 24 in August 2018, shot up to 40 on the opening day, and has really just been kind of on an upward march since then. So looking at defense spending, this is one, we like to show this chart, and you'll see on the chart that S&P 500 sales growth is in the gray bar, defense spending growth is in the blue bar, so effectively defense revenue growth, defense industry revenue growth. And then you can see the differential is the lighter blue line going through the bars. What we like about defense spending, it is largely cycle agnostic. It's more impacted by the presidential cycle and congressional cycle. And what that does is it just creates diversification in portfolios. So regardless of a Democrat or Republican leading the White House or Congress, we think defense always has a place in a portfolio, largely because of this natural hedge or natural diversification it creates. And so we saw a lot of volatility in 2018 with Mattis resigning at the end of the year. I think it was October. That was related to President Trump talking about budget cuts and pulling out of Syria without really consulting Mattis was what our understanding was. And then in 2019, you saw growth resume where it looked like Trump was pushing for increases in defense spending. And that led to a big rebound in defense last year in defense names. And, we participated in that. 2020 really began with heightened Iran and North Korea tensions, and now, with China. Interesting to see where that goes, but our view is defense spending is going to remain elevated for the foreseeable future. So looking ahead at some more of the longer term themes that we think are going to play out over the next few years, 5G telecom. We think we're in very early innings, kind of second inning, maybe third inning of a multi-year build out supported by the FCC and the White House. Renewable fuels. This is state low carbon fuel standards. This is EPA. This is other technology that's really helping drive that renewable fuel growth, but it's policy that's driving that. Media deregulation. We'd like some of the local TV stations and also just have to call out 2020 political ad spending likely to be elevated in our view. So that's just a bonus to that theme. And then cannabis legislation, long story short, we're pretty negative, actually very negative there. So 5G telecom, as I mentioned, a multi-year build out. What we're seeing is a significant uptick in this telecom network spending. And what we're also seeing is the FCC and the White House are supporting a faster rollout, largely because of whoever gets 50% or higher market share. So it's effectively Western companies versus Chinese companies. whichever one becomes 50% market share becomes the incumbent, and that becomes the global standard. And that's something that I think people don't understand. That's really important because that becomes the global standard for 6G, 7G because of the technology behind 5G. The interesting thing about 5G is it's a much denser network. So it requires, you could think of it almost as like a Wi-Fi router on every fourth telephone pole. You can't have these big towers that cover a whole, small suburb. You actually need much more density. So you need nodes really everywhere and packed in. Well, that's good for a lot of companies. It's good for the equipment manufacturers. It's good for the asset managers and the cell tower REITs, who we think are going to be the asset managers for that node densification. And so that's how we're playing it, is through Western equipment, through the other 5G type service names, as well as those tower REITs. And you can see the spending. I think the market got a little ahead of itself in 2018, where 2019 was a bad year for the 5G names overall. And then 2020, we're seeing kind of that growth resume and expect that to be a strong theme for the next few years. So looking at renewable fuels, there's a couple things going on here that I'll touch on. One is, on the right side, you'll see the EPA finalize this rule allowing year-round ethanol production. That just helps steady the demand, steady the production, make it more economic for those ethanol producers. You also saw this ethanol tax credit, which gave them a cash boost. And then we're seeing, state low carbon fuel standards that provide tax credits backed based on a fuel's low carbon intensity. So all these things are really supportive of ethanol. The other area that we're looking at too is on this left side, these renewable portfolio standards. This is effectively mandating what percentage of electricity must be produced from renewables. And, I think it's by 2050, if I recall, but you have a lot who are pushing for this, really major changes by 2030. And what it is using renewable fuel sources for electricity, as I mentioned. So really kind of seeing continued support for renewables, but it's a state story. You see that it's states leading this. It is clearly not a federal initiative because there's a lot of gray on there. So there's the states who aren't doing anything on renewable portfolio standards yet for electricity generation. And don't forget uranium. I just want to call out uranium. I mean, I think people probably saw in Andreessen's letter this past week, I think that was Monday, but really he talked about nuclear, and it's something it's controversial, but in our view, it is one of the cleanest fuels out there that we have, cleanest fuel sources. I guess the bottom line is we're not expecting big increases in U.S. reactors. We're kind of expecting it flat and uranium demand flat in the U.S., but what we're seeing is 50 new reactors, 50 new reactors going in India and China over the next 10 years. And the market's going to be structurally short uranium. And so we're playing a couple of uranium names there because there are some policy tailwinds there. So looking at media deregulation, this is what we've seen is, if you think about, your local Detroit market, for example, you have your ABC, NBC, CBS, let's say, Fox. Historically, the FCC has restricted how much a local broadcast owner can own of the broadcast rights. So you couldn't own, let's say, 50% or 40% or more of the market share of kind of the eyeballs watching the local channels, those local stations. Well, now the FCC has started to review those local market ownership rules because they've realized that these local broadcasters are now competing with digital advertising like Google and Facebook, Twitter, Snapchat, as well as streaming media. And so they've started to discuss relaxing those local market ownership rules. And we think that leads to further consolidation. We think that leads to better pricing power at the local broadcaster level, where they can negotiate for higher retransmission fees and really lead to better revenue and margin and profitability. And then also, I just have to call out political ad spending. Nearly half of it goes to TV, and that's local TV. And our expectation is going to be a large political ad spending year. So that's just really a gravy on top of this thesis. So I mentioned I would touch on cannabis. Looking at this chart on the top left, this is the average wholesale price per pound of cannabis. And what you see is, those first three are legal for medical use. You don't see a huge drop. The bottom left will show you the average price change in the first year after legalization. So you see after it goes legal and medical, not really a big change. You see a little supply come in the market, but not, nothing falls apart. What happens though when it goes recreational, the floodgates effectively open. All of a sudden you have warehouses pop up, greenhouses, And the thing about cannabis is it takes 4 months from planting to harvesting to having an end product. So it's very fast to create additional supply, and you see that happen when it goes legal. And what do you know? Massive supply increase, incremental, slightly higher demand, you see price collapse. And that's our view on cannabis, is largely you're going to see continued incremental demand or new demand met with massive oversupply. And so that's our biggest concern on the fundamental side. On the regulatory side, it's still a patchwork of state regulations, and there's no cohesive regulatory regime for cannabis. And you have all the federal banking issues still. The SAFE Act passed the House overwhelmingly and then got to the Senate and just died effectively. And so that's not going anywhere. There's talks about revamping that right now, and that helping to ease some burden that's going on in the cannabis space. We just don't see that happening. So the taxation, regulation, the banking, that stuff's not going away anytime soon. There's employer concerns about drug testing. There's DUI concerns at the local government level, and state and local government level, and then the federally insured banking, as I mentioned. So we just are very concerned about the attractiveness. We think when it goes legal on a state level, you get this oversupply. We're a long way away from federal legalization, but you're still going to have this oversupply situation and really no policy support for the space. So just 3 more, and I don't have charts on these. I just want to touch on them because I think they're talked about a lot. We get a lot of questions on them. So healthcare, and especially I think now, like managed care, everyone was concerned about this single payer, this meta for all, Medicare, Medicaid, meta for all, I'll call it. We think very, very low probability. And we think with Biden effectively the nominee now, we think that it's very low. Now there's talk with this current crisis and it's coming back up. We think when there's talk about it, it gives you an opportunity to buy some of these managed care names at really good valuations. So we use the opportunity for the political fear. It's really not a policy risk in our view. It's the political noise. We use that as an opportunity to add to these managed care names. So wanted to call that out. Healthcare innovation is a big theme for us. We really like the value-based care. It's really supported by CMS. It's kind of the second stage of ACA, is really focused on quality, not quantity. So focused on outcome-based care, that value-based care. So we're looking at opioid-free alternatives. We're looking at these outsourced clinical research trials. We're looking at tech companies like Teladoc and others who help enable more efficiency and drive down costs in the system. And then lastly, these government services and technology. We have, law enforcement body cameras in there, some property REITs. The government is your tenant, not much better of a tenant than one that can print money. And then, some labor compliance software like the Avalara I mentioned. So I want to wrap up just on this, and then I'm going to share one quick thing after this. But again, policy, not politics, and really how to think about policy is really adds diversification to a portfolio. So these policy catalysts are long term with their own unique drivers, and you can see that if you look at our PLCY versus mid caps, SMID caps, since the fund is roughly 75% SMID caps, it moves differently and behaves differently than SMID caps, despite it having such high exposure to SMID caps. The thematic exposure really gives you, these companies and exposure to companies that are undergoing change due to regulation and policy. And again, we like that lower correlation. And lastly, like for those who are more client facing here, wealth management and private wealth advisors, the client experience we've been told is really positive. So a lot of times clients come in with these emotional, biases, whether they're political biases or other emotional biases. If it is political leaning, this helps give the advisor the opportunity to translate it more into a policy discussion. Talk about these themes that are actually relatable, tax reform, deregulation, healthcare, global trade, infrastructure, things that matter to people that they're hearing about in the news and actually do impact their day-to-day. And just lastly, I'm gonna fly through this in 1 minute because I think the goal is to talk about policy. But what happened as we were putting our research out there and sharing with people, here's what we're doing in portfolios and here's why, that took off. And it took off so much so that people were saying, can you do more? This is some of the best stuff I've seen. It's very user-friendly. It's actionable. I can use it today. I can use it with clients. And and we heard that so much, people asked us to expand it, broaden it out beyond just policy. And that's why we spun out all of our research in a market desk. And so that's, it's a subscription-based model. That's where all of our independent views, we have a separate kind of research effort there going on at Market Desk. But, we cover sector insights. We cover, Friday Strategist. Every Friday is our most popular piece. There's a weekly with lots of quantitative information. Top 10 ETFs monthly is really popular, just to show you how those look. And then, the weekly market guide is really popular because it's kind of your Wall Street Journal of charts. So that's the core research. And then idea generation, there's thematic playbooks monthly. I mentioned the Friday Strategists, and there's lots more on the website, and as well as, additional reports coming soon. So I want to share, if anyone wants, a trial, free research trial, we give free 1 month trials. For the full year, it's $1,800 for a team of 5, just to be upfront with what that costs. But yeah, if you want to learn more about that, feel free to go to Market Desk Research, or just email me at ben@marketdeskresearch.com. If you want to learn more about the fund, email me at ben@eventshares.com. But thank you all. And I think we're going to take some questions now.
Yeah, thanks for that, Ben. So for anyone that has additional questions, if you hover over the screen at the bottom, there's Q&A buttons. Just type your question in there, and I'll try to answer it for you, or get it answered for you. Some questions that have come in already. Have you been seeing any additional automotive policies that for the automotive industry come up through the CARES Act, obviously, or do you foresee any, especially with everything that's going on and the drawdown in a lot of the demand for cars and autos?
Yeah.
Or even just future technology?
We've been tracking automotive, specifically the CAFE standards and the divergence with California standards. That's something we've been watching very closely, because California is almost like its own little economy, right? On its own, with its own regulatory regime, and a lot of times at odds with federal policy, or maybe sometimes in front of it. And so we watch both, and that's been something in stream we've been watching for years. This isn't just, part of the current crisis. So we write about that, we watch that. No conclusions, I would say, today on where that's going to shake out, other than we're going to have continued push for higher fuel efficiency and lower emissions, as far as lower levels of particulate matter and carbon dioxide and that kind of thing. So we're expecting that just to be a broad trend continuing, but haven't drawn any conclusions about where that's going on, specifically on CAFE standards. I didn't see anything in the CARES Act. The only other comment I would add on automotive is we just saw data coming out of China. I think it was last week, where the automotive demand all of a sudden picked up as soon as lockdown restrictions were eased. And so there was actually pent up demand. That was a little encouraging to me, to see that the consumer still felt good there. And we'll see if it's the same in the US. But I do get the sense that there's that similar pent up demand. For automotive. I'm actually in the market, and I'm not going and test driving right now. I'm going to wait for another month or so. So I think there is that pent up demand. It'll be interesting to see how much that actually plays out, but it's out there. But I haven't seen anything specifically on policy, support of automotive yet, but stay tuned.
Okay. Another question came in. What is your fund's methodology for determining whether the policy changes you have identified are not yet incorporated into prices or are fully priced?
Yeah, great question. I can tell that's from a CFA charter holder, aspiring CFA charter holder. The way we look at it is we look at 3 criteria, and I'll just share the portfolio. And the portfolio is at EventSharesFunds.com, just so you can see kind of what's in there. This is as of 3/31, but what we do is start with the top down. We start with those policy themes that are in gray there, and we have kind of a constant list of 25 to 30 investable themes, we call them, and we look at those. What we do is we score them at least quarterly. And what we're scoring them on is kind of order of magnitude. So how much of an impact this is going to have on the industry from a revenue perspective or a margin perspective. We score them on degree of certainty. So, is there a bill sponsor? Is there a regulatory agency already tasked with this? We're only investing where there's already something underway. We're not speculating this is going to happen. It's this has happened, and this is how it's going to play out. So that's a key differentiator with us, and different from how I've ever invested, in that I'm not trying to speculate on what's going to happen. I'm actually seeing this has happened, but the market's not aware of it yet. And the third component there is timing. There has to be a known catalyst within 24 months. So like IMO 2020, January 1st, 2020, that was happening. We've been investing in it for over a year. So we look at those three. What we do is we score each one of those criteria for each one of these themes, and the ones that have positive scores end up in the portfolio, and that scoring process drives the weighting. And then we have a similar scoring methodology for the individual names that are exposed to those themes.
Okay. Interesting chart that I thought was, the increase in policy sentiment driving decisions, right?
Mm-hmm.
You had versus unemployment and other factors. And it really seemed like it ticked up about 10 years ago. What catalyst do you think happened, we'll call it, to really drive government policy as this new sentiment indicator that helps businesses drive decision making?
Yeah, I think what it largely was, and I'm trying to get the chart up if I can get my PDF to stop freezing. What we thought it was really kind of in the Obama era was the beginning of a lot of executive actions. And so that's what we saw. Really, when we saw it start to tick up pretty meaningfully, it was during Obama's presidency and starting to use more and more executive actions to drive policy. Trump's administration, before they entered office, or kind of right in that transition period, he went out and hired pretty much every high quality trade lawyer that was in DC or New York to help them start to address trade through executive action. And so I think what we saw was just, it started in the Obama administration, more and more executive action, and really Trump took that lead and really poured some gasoline on it for utilizing executive action to drive policy. And so that's, in our view, what really drove a big chunk of that kind of uncertainty or just top of mind nature.
Okay. Does that, you feel, undermine a little bit then the democratic process if you're just executive ordering everything?
It does bring in question, what the future of our democracy looks like, how these checks and balances really do work. And so that is something that, we're keen on watching and analyzing, how does that play out? Are there some, Supreme Court decisions that are going to drive more checks on those, unilateral executive powers?
Okay. Another question that came in. Can you elaborate on the Sino-U.S. relation policy, like immigration ban, manufacturing outsource versus insourcing, the 5G war, chip wars, and cybersecurity accusation on TikTok? So obviously there's been a lot of rhetoric around China-U.S. relations, and truly, obviously I think everyone's noticed if we have to get our medicine and other supplies from China, what does that really do from a manufacturing standpoint and actually re-onshoring things? Do you think that's a big driver here going forward?
Yes. We're in the very early stages of this, right? This all just kind of kicked off in the past month. It's been a concern of ours just from an investing standpoint. It's been something that we've focused on. It's I think, a large reason of how we got here as policy investors, in that we were looking for the course of our career at, manufacturing companies. You had Caterpillar go over to China with a forced JV and a forced IP sharing in the 90s. And then they kicked them out not too long after, I think within a decade, and said, okay, thanks, we got everything we need. And all of a sudden you're seeing these beautiful yellow, kind of off yellow equipment coming out of China, but it doesn't say cat on it. It says a Chinese brand. And so that's been something that I think the investing public has been focused on for decades now. And all of a sudden when we see that there's a real need for, from a human's perspective, and maybe not just commerce, then I think that's when it really hits home to people. And so we are expecting action. I think that's something we're in the very early stages, but long-term trend, we would expect more onshoring, particularly of healthcare products, pharmaceuticals, critical goods. And if you look at like the Section 232 stuff that the Trump administration was doing, that was the trade policy that they were utilizing for national defense, Section 202, 232. And really, they were using national defense as a big driver for their trade policy initiatives. And uranium was an interesting one that we were looking at that was under Section 232 study for national defense, and it ended up, Trump administration ruled that it's not critical to national defense, which was interesting. So it's been curious to see which areas are considered national defense and which aren't. But I think when we talk about healthcare going forward, I think our expectation is we see a lot more push to drive innovation, drive production, particularly in supply chain management, warehousing, inventory in the U.S. and keep it in the U.S.
Switch up a little bit, I guess, on just due to the election this year. What do you think the biggest differentiator might be? Or how would your policy or themes change? If Biden somehow won versus Trump.
So
if you want to comment on just Biden's ability to campaign and actually have a realistic chance of winning and campaign with the overall situation, with a lot of people not being able to go to events and rallies and things of that nature.
Yeah. We've been focused on just exactly, looking at Biden's campaign. He's from a personal standpoint, he hasn't been communicating that clearly, and the market is, I think, looking at that, and those who are wanting, Trump out of office, that's upsetting to some. I think from a policy standpoint and how that impacts our portfolio, that's how we look at it. So the politics we largely ignore. We're politically agnostic. We don't care if it's Biden or Trump outcome. We know there's opportunities in either outcome. But in a Biden outcome, you'd be surprised. Like if you look at the portfolio, the themes that are in there are largely agnostic to what's going to happen. So if you talk about like 5G telecom, that's going to stay under a Biden outcome if he wins the presidency. Healthcare innovation, that's going to stay and maybe grow. Government technology, that stays and maybe grows. Defense, that one probably shrinks a little bit. IMO, that's its own thing. That stays, or it's its own drivers. That has nothing to do with Biden. Infrastructure, that's state spending. That maybe grows slightly as there is, Democrat support for infrastructure and maybe more impetus to do something there from the Democrats currently. And then, renewable fuels, that probably grows. So if you look at our portfolio, like we would expect only 20 to 30% of it to turn over in the following month after a Biden outcome. And again, we're not speculating on what's going to happen. We would only change that after that outcome occurred. And so you maybe miss the first 5-10% of the move, but you capture 90-95% of it over the following 6 to 12 months.
See here. Yeah, with that being said, what do you think the biggest differential at this point between, it seems that over the years, the main factors, the differentiators between Republican and Democrat, I feel like they've merged to an extent, especially on, I guess, the corporate standpoint, especially this latest, we'll call it, crises that we're facing. The Republicans are very quick to, have huge stimulus bills, supporting lots of different corporations, all different industries. People blamed the Democrats for bailing out companies. Now Republicans are bailing out companies. So what really changed? What are the big differentiating factors or themes between a Democrat and a Republican sort of policies that they try to pass?
I kind of get embedded in that question is there anything, is there such a party as a small government party anymore? I think that's partially being asked in there, and our view is no. It's looking at the Republican Party and the Democratic Party are all for big spending. And this was, I was saying this 3 months and a year ago, before, the coronavirus. So I think our view is spending restraint has been thrown out the window for years. It doesn't matter if it's Republican or Democrat, there's spending. Now, there are differences as far as where the spending is going. And, I think that's where where I mentioned, some areas of the market that we would see a change, like if Biden won the presidency, for example. But there, the bipartisan areas of the market are bigger government. So that's why we like this government technology and services bucket. 5G telecom is supported by both parties. Like infrastructure, there is bipartisan support there. So those are areas where we're seeing a lot of bipartisan support. As far as the areas that are more Republican leaning, I would say deregulation, financial deregulation, energy deregulation. That's we see that theme continuing and expect that theme continuing. So just less regulatory oversight and more kind of just let the market determine self-regulate, I guess. Democrats were seeing more push for broader healthcare initiatives, more social safety nets. So those things remain, those kind of core parts of the Democrat-Republican Party. But as far as kind of Republican Party being more small government or focused on, size, that's not a thing anymore. Now, intervention and how much government's involved in things, you still see maybe Republicans paying lip service to that, and also some truly believe and try to enact legislation and regulation to help that. But it's interesting to see this convergence as far as big government, but divergence as far as political polarization. That I hate you because you're a Republican, or I hate you because you're a Democrat.
Right. That chart where is 90% now. It seems counterintuitive since they ultimately end up acting in very similar natures. So
yeah, no, it's like I hear the question.
All right, I got another question here from the audience here. How do you analyze unfunded mandates, policy aspirations without clear funding to achieve? I don't know if that's clear for you, but
no, that's a really interesting question. Well, I would actually ask the person who asked the question, and maybe put specifically what areas of the market they're thinking of, because that's a broad question. But I think largely where we invest, or where there's a known certainty of something occurring. So if there's something changing and there's not funding there or support, that's tricky for us, and you won't see it. You probably, in those themes you're looking at, it probably isn't in those themes if I'm guessing right, what you're asking. But if you look at kind of like Medicare, Medicaid, Social Security, I think that might be where the question's going. That's a problem. I mean, with the borrowing that the U.S. is incurring with this fiscal stimulus, with the Fed actions, that has to be funded, and that has to be funded, now effectively. That just further adds to our long-term liabilities. We are borrowing from the future, and at some point, the U.S. will have gotten to a position, we think, and this is over the next 10 to 20 years, next 10 to 30 years, where the U.S. is in a position where they're over-levered. And there's going to be, we think, a day of reckoning, whether it's a forced deleveraging because the bond market says, no, I'm not going to own U.S. treasuries anymore, or something else. We think it's, at this current rate of spending, deficit spending, government spending growth, without, the revenue and the economic growth to support that. It just doesn't work. And I think there's plenty of credit analysts, I'm a former credit analyst here too, that are looking at that and say, this doesn't work. If the US government were a company, I'd be saying, man, I do not like where these credit metrics are going.
Yeah, well, maybe the S&P might downgrade in one day then. One policy change which might persist is unemployment benefits for gig workers. Do you agree? And what sectors would be affected?
Yeah, that's something we're watching closely. I mean, we're watching this PPP and the disaster there. Like gig workers, if you talk to anyone who's, and even companies my size, like it's very tricky to get any action or any progress there. The banks won't look at you. They're only dealing with their long-term clients. There's so much of a log jam in the system, like with this PPP. The individual independent contractors, we think, like, are going to see almost none of that money or nothing significant. So we are looking to see if there's going to be anything else. We're not seeing any specific legislation currently that is specifically addressing that. And Mitch McConnell, I think, just said today that it's not going to be until May 4th, when Congress is back in session, that you see another fiscal effort after this current one goes through. And so I don't know. It's a tough spot. I think it's going to fall a lot on states to try to do something, but we're not seeing anything right there. So, if there were to be something, it would clearly help help the tech industry. It would help, a lot of like the food delivery, the Ubers, the Lyft drivers. These are a lot of people who have gigs, side gigs, or that's their full-time gig. It's I'd say my takeaway is we're just in a very tricky economic spot right now. We do need to get the economy functioning and opening cautiously, but just I think opening and get activity back in a smart way, because each week that we're closed as a U.S. economy, it's 1% drag on GDP. And you get to a point when you've had 10 weeks of closure, you're doing serious structural damage to the U.S. economy. You're doing serious structural damage to the labor market, to the point where I wonder, economists wonder, and the analysts out there wonder, how can we ever recover from a 10% GDP loss, and the structural damage that does to society, does to employed individuals out there. That's really kind of not even an existential question. That's something that's huge and matters very much right now, and we're living it day to day. So I think that's why we have to do it smartly, open up the economy, and be focused on health, and be focused on doing it so we aren't increasing this COVID-19 spread. But each week we're closed. There's a human cost there. You're talking about their lives on that side. If you have a 10% GDP loss, the loss of employment, the mental health issues that come after that, there actually are lives you can tie to that too. And so we're weighing this, disease versus other death, just to say it from an analytical perspective, and not discounting how impactful this is on everyone's lives. We just worry about the long-term implications and the impact of structural damage to the labor market.
All right, last question here, and I'll sort of ties infrastructure a bit, so I'll wrap it into there. Do you feel like the infrastructure bill that they keep touting, that's phase 4 of this, sort of stimulus packages that are rolling out here due to COVID, do you think that gets passed, and how big? And what types of infrastructure spending do you think it'll be targeting? The specific question that is from the audience here is, do you think a large portion will go towards healthcare spending, upgrading America's hospitals, and especially rural community hospitals?
I think that in order for it to pass the House, I think you're going to have healthcare spending. I think in order for Democrats to vote, they're pushing very much for healthcare infrastructure upgrade. I think what they're going to do is like what they've done with the past 2 or 3 defense bills, is dollar for dollar domestic spending, with defense spending. It's going to be the same thing on an infrastructure bill. They're going to say, okay, dollar for dollar, or maybe figure out some sort of ratio that works for Democrats and Republicans. But we're going to see, increase in healthcare infrastructure. What that's going to do is just grow the size of the bill. You're not going to see, I'm going to cut some here. The lack of spending restraint is going to say, no, we're just going to increase the size of the bill. And yeah, you want some for hospitals, here you go, and healthcare, here you go. But we're going to spend more over here too. So it's just going to increase the size of the bill in our view, which then it starts to run into, size issues, and if people are against, more and more government spending. But right now, again, I think we're not seeing that spending restraint. Where else does the infrastructure spending go? I mean, it goes to transportation. We still are in desperate need of it. The thing about a federal bill, though, is it doesn't happen overnight. So let's say they passed it tomorrow. They passed an infrastructure bill. Let's say it's $2 trillion. While that's going to be reflected a little bit in the names, that takes years to roll out. And so that's why we're still focused on the companies that are benefiting from state spending, because they are really, seeing states have taken it in their own hands. They can't wait around for the federal government. They've learned that the federal government takes a long time to act on this. And so they have to upgrade that infrastructure, hence why the states are spending. And you've seen big spending increases from the states since 2012-13, when they started hiking fuel taxes, and double digits last year is around 10%. We're expecting a similar infrastructure spending this year with just state spending. So if federal does come in, that's gravy, but it doesn't happen this year. It takes from kind of that infrastructure bill passing, you have you have the zoning period, you have kind of all the speccing, the architecture and engineering side of things. That takes 2 to 3 years. So it's going to take 2 to 3 years to get those infrastructure dollars out, in our view, and from a federal bill. So it really is still going to be a state thesis, but the federal, as I mentioned, it just extends that thesis longer. It extends it out to 2025, 2026 versus kind of the state spending we think is at current rate going to be kind of played out through 2022, 2023.
Okay. Well, Ben, thank you so much for delivering this webinar versus being able to come to our society and actually present in front of us. Appreciate it very much. And
thanks for having me.
No problem. And for all of the society members, I hope you enjoyed this presentation. I believe you guys have sort of gotten a lineup for the next couple months as we've moved most of our in-person meetings to these webinars. So I hope you enjoyed this one and look forward to having you guys in the future on more.
Yeah, and Vince, thanks again. People are asking for slides, and if you want to email me at ben@eventshares.com, I'll shoot them over to you, and I'll also shoot them over to Michelle.
Okay, perfect. Appreciate it.
Great. Thank you all. Take care.
Bye.